Welcome. This is Mark Muller from Sanlam Private Wealth. I'm a director coming to you from Mauritius. Welcome to our webinar. We are very pleased to be hosting Alwyn van der Merwe, who's the Sanlam Private Wealth Group's Chief Investment Officer. I would read Alwyn's CV, but it's going to chew up all the time that he has. But succinctly, Alwyn obtained his BCom Honours and MBA degrees from the University of Stellenbosch. Alwyn was appointed as Director of Investments for Sanlam Private Wealth in 2007. He has over 24 years investment experience and managed institutional and unit trust portfolios successfully for 14 years. Alwyn leads and chairs Sanlam Private Wealth's Formal Investment Committee. Alwyn, as always, it's a pleasure to have you on board. But before I hand over to you, just some housekeeping issues. We do have an opportunity for you to ask questions. Please, would you email those through to me, either raise your hand or send it through on the chat icon at the base of your screen, and we'd happily pass those on. We are pushed for time, so I am going to immediately hand over to Alwyn. So Alwyn, coming to us from Cape Town, South Africa, thank you very much for once again joining us. We look forward to your input on what is a tumultuous time in global markets, and you know, not a great time to be a PM of European countries, it seems. So Alwyn, straight over to you.
Good afternoon, Mark. Can you just allow me to share my video, please? Okay, it doesn't seem to, the system doesn't seem to take my video. Let's see if I can do it again. There we go. Good afternoon, ladies and gentlemen. And Mark, thank you very much for the kind introduction. As you say, we are pushed for time, so I'm not going to say a lot. I would like to immediately share my screen and get going with the presentation. Mark, can you see my full screen?
Yes, you can see your full screen. Thanks, Alwyn.
Thank you very much. Once again, ladies and gentlemen, it is indeed a privilege to discuss our views on financial markets. And I think, you know, despite the fact that, you know, we all live in the real world and we fully understand that it is, as Mark said, extremely uncertain times. You know, it is the same for everybody if you run other people's money, and that is what we do. So we have to make sure that whatever our views are, that those views ultimately follow through into proper portfolio management decisions, where we try to manage the investment outcome on the one hand, but also the risks that are currently associated with the environment. So what I would like to do, I would quickly just like to give you a bit of a recap in terms of what has happened in financial markets. Then I want to tell you which questions I think are the most important questions that people should ask about markets, how we see the world, and how we manage it in our portfolios. So just very briefly, you've probably all read the headlines that if you look at global equities, it was the worst first half for global equities since 1970. And for those of you who are as old as I am, who's lived through the 70s was a horrible period for financial assets. And it was also the time, certainly in my lifetime, that we had a period of very high inflation. And the 1970 period was really leading into that period of sustained high inflation in the 70s. So if you look at the performance here on this particular slide, I'm just showing you the index, the S&P 500, which is the general index or price index for US equities, and the NASDAQ, which is specifically information technology shares focused. And you can see both of these indices, they have peaked in roughly about November last year, and then a significant sell-off in both those indices in the first half of the year. And if you look at the actual numbers, the S&P 500 has lost about 20% of its value, and the NASDAQ, which had a phenomenal performance since COVID struck in the first quarter 2020, that sold off by almost 30%, 29% over this particular period. So it was dramatic for quite a few people. Some of you who were part of our discussions into last year would recall that we have said that the NASDAQ in particular for us appeared to be quite risky. The story was a wonderful story associated with those information technology companies, but from a valuation perspective, we just felt that some of those companies are trading at very expensive levels, and should the news flow change negatively, there's risk that those shares can sell off. But you know, when we talk about the equity markets for the first 6 months of this year, unfortunately, there was no place to hide. Because if you look at what happened to treasury yields in the United States, you can see that those yields traded at about 1.5% in December last year, and it shot up rapidly to about 3.5%. Now, you must remember that the capital value of treasury or a bond is inversely correlated to the yield. So despite the fact that the yields went up, the capital depreciation as a result of this pickup in the yields meant that the prices actually went down. And over this particular period, even the so-called safe haven asset, which used to be, or that many people regard as 10-year government bonds in the States, that has come under severe pressure, and it's lost 10% over this particular period. And then if I may just share one or two finer nuances of the market. It was very clear to us at the end of last year that growth shares, and the NASDAQ I spoke about, that was way too expensive. And you can see that if you look at growth shares, so those will be the information technology shares, look at this particular slide, that they've lost almost 30%, where value shares also went down, but not nearly to the same extent. So there were finer nuances within the market, but there was generally no place to hide. And the only asset class that actually performed well was within commodities. Energy did well as a result of the war and the oil price that went up as a result of that. So with that as a background, you know, that is how it was. The point is, how do we manage other people's money from today forward? And that is, I think, the crucial part. Now, if you believe in mean reversion, in other words, if you think that trends recover to trends, then I guess that many people might argue that since those markets sold off significantly, that might be an opportunity to buy back into those markets. And I would like to pose three questions. The first thing is, as I've mentioned, when we spoke to yourselves and other clients end of last year, we said the big risk, of course, was inflation. And it was as a result of inflation, the risk that interest rates will go up, and therefore, you know, economic growth will come under pressure. So we have asked ourselves, but why is it that we saw it in December, but the market was quite sanguine about it? Why did the market only just really responded in from about February onwards? That is the first question that I would like to answer. The other question is, and the one that I actually shared with you already, is if the markets have sold off, you know, why don't we buy in? Or what must happen before, what will trigger an action to buy these shares? And then finally, you know, if you believe in so-called efficient markets, you know, you might say that, oh, then all the bad news that you're likely to talk about should be baked into prices, and therefore you should buy. And I would just like to provide answers to those questions. So the first thing is, I think I want to put our cards on the table immediately. When we look at the economic outcomes, we think there's a possibility of three outcomes. And then we also assign a particular probability to those outcomes. And the first one is a soft landing. In other words, economic growth slows down, interest rates go up, but despite the fact that interest rates go up, you don't go into recession in the US or in Europe or in the rest of the world. So that is a soft landing. Slower growth, but not a recession. We don't associate a high probability with it, and I will discuss why that is the case. The other probability is a hard landing. In other words, interest rates go up, you can't avoid a recession, and the US and the world goes into recession, and of course it will have certain impacts on financial markets. And then thirdly, you have a start of an inflation spiral with growth rates being low. So that is, if I may, that is probably the definition that you will have for stagflation. So you go into a period of stagflation, which is a period of sustained higher inflation, but with very modest growth, not outpacing inflation. Now that can also come about, and I will talk about that. So let's just look at the facts before I try and give my opinion on it. The first thing is, if you look at inflation across the world, you will look at this particular chart. The chart on the left-hand side is US headline inflation, and the blue line and the black line is core inflation, which is probably the better one to look at. But nevertheless, you can just see that the inflation went vertical. And if you look at this graph, it actually goes back to 1960. You need to go back to the 70s when we saw inflation going beyond that 6% level and into double digits. So I'm not saying it's going into double digits. I'm simply saying that for people who look at the current situation, if you plan for strategy, it might not be appropriate to look at what has happened in markets since 1980s. You need to look back to the 70s. And secondly, if you look at Germany, just to use an example, for Germany, for Europe, you can clearly see that if you look at headline inflation, it is seriously high. The blue line, the more appropriate one is core inflation. You can see it's 4%, which is also high, and it's been the highest since 1950. So that is the reality. We didn't write the script. That is how it is. What we need to do is say, okay, so how do we navigate portfolios around these obstacles? Now, the people who need to take notice of this, of course, are the central bankers, because they've got a mandate to bring inflation down. Now, it is very interesting. So what will they do to bring inflation down? You know, the central bankers don't have many tools in their toolbox, but the one thing that they do have in their toolbox, of course, is interest rates. So if inflation is an issue, then they are likely to hike interest rates. Now, in this case, and this graph goes back to 1960, you can see that this light brown line is just inflation. We call it the PCE deflator, which is just another measure of inflation. And you can see how that picked up, which ties in with the previous slides. Then the blue line shows you what the Fed funds rate is. So that is the policy rate that the Fed would use to try and curb inflation. And you can see it's only now that the Fed fund rate is starting to go up. The brown line and the black line is what we call the so-called Fed funds future rate. And it tells you what the market thinks the Fed will do with interest rates towards the end of the year. And if you look at that graph carefully, you can see that the market has turned more bearish, in other words, more negative in terms of what the Fed will do. That they reckon now that the Fed will be more aggressive in trying to curb inflation than what they thought a year ago. So to answer the first question that I posed, why did the market only respond now and not in December? The market was simply too sanguine, and these higher inflation numbers that we're seeing now was a surprise to the market. And now only the market is starting to price that into the asset prices. So it works through into bonds, and it also works through into the equity market. Last point, and this is not an alarmist point, is that if you look at the actual level of the PCE deflator or the inflation measure that I've used here, you have to go back to these kind of periods. So that is the late 80s, and you can see that interest rates were significantly higher there compared to where we are now with this inflation rate. We think that this should drop a bit, but there's enough justification to be concerned about higher interest rates going forward. Of course, and that will have an impact on economic growth. And instead of using our own growth forecast, we've used a very reputable economist, Morgan Stanley, their economist. So if you look at global growth, this is just the pattern of global growth. It grew quite strongly during the 5 years leading up to COVID. When COVID hit, you can see the big hit to this blue line when economic growth came under severe pressure globally. And then as a result of phenomenal stimulus that we've seen, you can see how the blue line recovered and economic activity recovered. But what is happening now is that most economists are starting to downscale their economic forecasts. The dotted line here was the forecast that Morgan Stanley had for economic growth back in January 22. So only 6 months ago, they thought that this would be the path, that dotted line would be the path of economic growth. And what they've done now as a result of the inflation shock and the response of central banks is they have downscaled the economic forecast, where you can see that economic growth is dropping and then recovering again. So come back to the question, are we going to see a hard landing? I think the risk is if the Fed is really focusing on getting inflation down, that they are likely to make a policy error, and that these Morgan Stanley economists might well be too optimistic, and this blue line in the short term might in fact go slightly lower than what they thought initially. So hopefully I've answered that question. I'm not going to go through these numbers. So the point is, so how do we run this in our portfolios? And we think that cycles, firstly, is not uncommon. So as asset managers, we've got to make sure that we position portfolios according to what we call the investment clock. And the investment clock is just the interplay between interest rates and growth, and when it goes through different phases. In this particular phase, it's a phase of high economic growth and low interest rates. And then it normally moves into a period when growth starts to slow, interest rates go up, when inflation kicks in, and ultimately, if there's a policy error, the growth rate goes into negative territory and interest rates drops. So what we've done is we've backtested how specific financial assets perform in these four quadrants that we've explained, between the interplay between growth and interest rates. So if we move here, and this is where we are moving now, because that is exactly where we've moved. Growth is starting to slow, interest rates are starting to grow higher, or interest rates increase, then we've got to be more defensive in portfolios. What does that mean? It means probably two things. Don't have an overweight position in equities, because equities like high growth and low interest rates. Start to introduce bonds in the portfolio. And very importantly, don't think that only equities and bonds are the two asset classes that you need to use. You've got to use other asset classes as well. In other words, you've got to make sure that portfolios are properly diversified. And what are those? You can use hedge funds, you can use commodities, and within commodities, you can use gold. And of course, you can also use inflation-linked bonds, which is a very specific type of bonds that will protect the client's money against overshoot in inflation. So Mark, I think this is a critical slide. Cycles, certainly not uncommon, but you've got to make sure that you understand where you are on the cycle, and then you manage the portfolios actively based on your view on those cycles. So let's just quickly talk about price. And if I look at global equity prices, just to make it very simple, this blue line is the total return of the MSCI World over a period since 1985. So it's, let's say, roughly about 35 years of history. And this black line is simply a mathematical fit on this line. And what you normally find, when the blue line goes above the black line, it becomes the particular asset class, in this case, equities, become expensive. You've got to be a bit more cautious. And then you see normally something happens. In this case, it was back in 2001, and it comes back, and it normally doesn't stop at the trend line. It goes below the trend line, and then it picks up. So you can clearly see it's cyclical. We warned about expensive markets there. And for those of you who've spoken to Peter Fourie, he's warned about that as well. And you can see, of course, the accident happened, and now it is below that black line. So I think the time to have worried a lot about equities is probably behind us, but I don't think this thing is low enough to go and pound into the equity market. And one of the reasons why I say that is, if you look at the earnings growth, which is one of the factors that drive markets, we've had a phenomenal strong performance in earnings growth since COVID struck back in 2020. And we don't think that this trend will continue. And if we go into a period of low economic growth, this blue line of earnings is likely to come down, which will not be good news for equities. But the valuations are starting to look a bit more attractive. Last point that I want to make before I go into portfolios I just want to show you what happened to equities in the 1970s. In this case, I show you the S&P 500 index and in real terms. And this is what happened with the index, with equities in the 70s. It actually dropped phenomenally in real terms, but it did create a wonderful buying opportunity for equities at the time. But it normally, when you move into periods of high inflation, higher interest rates, equities don't like that, and it can come off. If you can kill inflation, and the sooner you kill it, the better, then the market can recover from those periods. How did asset prices perform in that period? I think it is very interesting. If you look at the far right, you can see the S&P 500 in nominal terms still generated a positive return over those 10 years, but in real terms did not. 10-year treasuries in the US did not protect you against inflation. Property, only just 1% real return, but in nominal terms up. But the hedge against inflation was actually in commodities. You can see the oil price did well, so Brent crude did phenomenally well, and the other asset class that I think is likely to do well if inflation really overshoots is gold. So how do you do that in portfolios? Well, it depends, Mark, what we have, and ladies and gentlemen, what we have for our clients who are interested in offshore solutions. We have a range of what we call multi-asset portfolios. Mark would call them model portfolios, but it's portfolios that we tailor-make for clients, but we put them in certain buckets. And those buckets are being defined by a risk and return profile of the particular portfolio. So we do a cautious one, a moderate one, a balanced one, and as you go down the line, the risk increases, and therefore over the longer term, your returns expectation should also increase, and then aggressive. So that is quite comprehensive, from low risk to high risk. And in these portfolios, we invest in a comprehensive range of asset classes. So you can include equities, fixed interest, commodities, alternatives that would include structured products, that would include hedge funds. And with that toolbox, you know, despite the fact that the cycle is very uncomfortable in terms of where we are now, we have the tools to negotiate through the uncertainty by actively moving the exposure of these different asset classes up and down, depending on how we see the cycle and depending on how we see the valuation within those asset classes. So the way we look at it now, you know, for equities, we will have a neutral position. So it's not a time to be aggressive for equities. Despite the fact that it's sold off, I spoke about the risk that the market might be wrong, that you might have a more dire economic outcome. So that is why we're not overweight. We also have a specific style. We like to, when we buy equities, we would like to buy quality equities because we think that there's more visibility in the earnings stream of those companies. So we overweight there. Fixed income underweight because there's still a risk that inflation can overshoot. Listed property, we are neutral. Cash will not help you to beat inflation, as I've shown in that one slide. And then alternative assets, should inflation kick in, I think you will need something unique. You will find them in some hedge fund, you will find them in some commodities, and we will bring that in the portfolios to protect clients' money and also generate enough growth over time. So that in a nutshell, Mark, is how we see the world, and very briefly how we manage that in the portfolios that we put on the table for clients. And it's a daily debate in terms of how we see the different building blocks changing in terms of value and the outlook for those. So for that, Mark, thank you very much.
Thanks, Bob, and that was outstanding, and it's a lot to pack into a short period, but good succinct summary. We're not going to be able to get to all the questions, mindful that we've got a couple of minutes left. I'm just going to run through the two questions that I thought we could deal with in the remaining couple of minutes. The first one is Goldman Sachs has put the possibility of a recession at 30%. This is according to their release last night, and Bloomberg has put it at 38%. What is your view on that, Alban, in terms of global recession?
Right. It is. I'll give you a quick answer. You can see that on this particular slide, and maybe I should. I think some in this slide, I don't know, it's deleted now, but nevertheless, we've got I think it was something like, there we go. We've got a 55% probability. You know, Mark, the point is, whether it's 38 or 35, we think there's, if we have to attach a probability, that there is a real risk that we can go into recession. And the reason why we say that, we think that the Fed waited too long to hike interest rates because they thought that the inflation pressures were temporary. And how it turned out is some of those inflation pressures is certainly not transitory. And we are starting to see second round effects of these higher energy prices and food prices, and a very tight labor market, which means there's, in the US and in Europe, there's a shortage of labor, and we see significant wage demands coming through now, which will, I think, lead to a bit more permanency in the inflation. So unfortunately, we have to say that probability is higher. The last point that I would like to make is a bit technical, but we look at when we look at the yield curve, and when the yield curve goes negative, in other words, when short rates go beyond long rates, 2-year rates goes beyond the long rates, that slope goes negative. And that happened yesterday. It also happened in March, and it's always been a reliable indicator of a recession to follow. So unfortunately, we're perhaps a bit more bearish, and therefore we also a bit more cautious in our portfolios when we position it.
And then we've literally got a minute left. The other question, and if we can deal with that in a minute, please, is, and I quote, what is the path to get out of this volatility in terms of portfolio management? And you touched on it in the main body of your presentation.
The short answer is diversification, and hopefully it's not diversification, but diversification. You know, when you include more asset classes, particularly if those asset classes are uncorrelated. In other words, if the one goes up, the other one goes down. That is uncorrelated. Correlated means they move in the same direction. So if you diversify in different asset classes where those asset classes are uncorrelated, you can reduce the volatility of the performance stream that you generate for clients.
Great, thanks, Alban. That's unfortunately all we're going to have time for this afternoon with Alban. I'm sorry that we didn't get to all the questions. Please feel free to email those directly through to me or to one of our PMs, and then we can come back to you. But Alban, as always, it's been an absolute pleasure to have you speak to us, and we look forward to many more. Thank you very much, everyone, for joining us today. Cheers from Mauritius.